Okay, hello there. Uh, I want to take this opportunity to welcome you to our class today, Management Accounting. And in our previous class, we had a discussion on management, on marginal costing, and we cleared out that particular section. Today, we want to embark on absorption costing. We want to embark on absorption costing. So that is what we will be looking through today. Let me try see if my whiteboard is working. So we want to look at absorption costing. That's what we will look at it today. So what is absorption costing? In absorption costing, we are saying that this is where all costs are absorbed in the production, and there is now no distinction between variable costs and fixed cost. If you remember, in our previous class, we had discussions where we said from our previous manufacturing class, we were talking of marginal costing equals to all the prime costs, plus the variable overheads. That is what we mentioned, and we went ahead further and said that from our discussion where we have our total cost equals to variable cost plus fixed cost. Sorry, I don't know why my pen today is misbehaving on the whiteboard. And we went ahead and said this could equally be written as total cost equals to our marginal cost plus fixed cost. So that is what we had there. Of course, we had issues of contribution, which just for reminding of our discussion last week, we said contribution is equivalent to profit plus the fixed cost, or what we would say our sales minus the marginal cost. So for our class today, away from our marginal cost on absorption, we are saying that under this particular one, all costs are absorbed, whether they are fixed or variable. And further, we are also saying that the stocks and the work in progress contains both fixed and variable elements. So the cost is composed of all the direct materials, all the direct labor cost, all the direct wages, and all the overheads. And it's a technique that is used mainly in financial account statements and cost account statements in some organizations. So you will find that all our financial statements are normally based on absorption costing. It's normally based on absorption costing as compared to our marginal costing at the end of the day. So what are some of the advantages? What are some of the merits or advantages of, I'll just be abbreviating because of my whiteboard. What are some of the advantages of this particular costing? I would wish to highlight the following advantages. And I'll have them over here, and for us to be able to have a look at it. So we have these particular advantages for absorption costing. One is that comprehensive cost allocation. There is a comprehensive cost allocation. So we are saying that absorption costing considers both variable and fixed costs, hence giving us a comprehensive view of the total cost associated with a product, a particular product. So we are saying, so number one, what we are saying, let me just have it here. So number one, we have a comprehensive cost. Comprehensive cost. Number two, on this particular absorption costing, is that it is compliant with the generally accepted accounting standards. Whether you're talking about the gaps in the US or you're talking about the international accounting standards, then it is also compliant with the standard. So we could say there is some compliance with accounting standards. So whether they are gaps or international accounting standards of accounting, then it's compliant. Number three, we are saying it provides stable product costs. Of course, the fixed manufacturing costs are included in the product cost under absorption costing. So this helps in smoothing out fluctuations in product costs that may result in variations of the production levels, hence giving us a stability in a cost per unit. Number four for our noting is it encourages production efficiency. Number five, it simplifies inventory valuation on the closing figures that we normally look at because all the costs are covered. And lastly, it is useful for pricing decision. It is useful for pricing decision. However, it also has the following disadvantages. We could highlight a few of them. It has some disadvantages, or what some people call the demerits of using absorption costing. It has the following. I would just have them for our information. One of them is difficulty in cost control. Since fixed overhead costs are allocated based on the production volume, managers may find it challenging to control and manage these costs effectively. So there's some difficulty in cost control. Two, it also may encourage overproduction because absorption costing can provide incentives for overproduction, as higher production volumes may help in spreading fixed costs over more units, hence reducing the per unit fixed cost, which might lead to accumulation of excess inventory. Because costs like assets, like rent, which are fixed in their nature, is now spread across several units. So hence, there is some incentive that when you produce more volumes, of course, it will be cheaper at the end of the day, which is true, but it can encourage overproduction. Then the fixed cost allocation, one of the primary disadvantages of this particular one is that the fixed manufacturing overheads are allocated to units produced regardless of the actual level of production or sales. And of course, this can distort the per unit cost when the production volumes fluctuate. So you cannot be able to tell exactly this production of one unit of a particular product X or a particular product Y has taken us or has taken the factory or has taken the company approximately X number of shillings to produce, because the fixed cost is spread across all the production units at the end of the day. The next disadvantage is that it is not suitable for decision making. And of course, we have said you find that financial statements which are going for majorly outside users, tend to lean towards using absorption costing. But for internal decision making, managers often prefer using variable costing, which separates the fixed and the variable cost. And of course, that particular marginal costing, which we discussed in our various class, now gives out classes and points where someone sits down to make up decision. The next disadvantage is that there is complexity in costing because it involves complex calculation, particularly when dealing with multiple products and various overheads at the end of the day. And lastly, this particular costing method is not ideal for short-term analysis. In situations where short-term analysis is essential, absorption costing may not be the most suitable method. Because variable costing is often preferred for short-term decision making, as it directly associates with the variable cost with production. So when you flip it on the other side, we are saying marginal costing is best on short-term analysis, while absorption costing is not best on short-term. It is best on long-term analysis. With those little remarks, I want to pick up a problem so that we have a look at it at the end of the day. And so I will just pick some parts of it, but I will just mention this particular problem, then we try delve into solving it at the end of the day. So let's have this example. Cuman Company Limited produces product K. Cuman Company Limited produces product K. So we have Cuman that produces K product, and the following information has been provided for us for the year 2020. For the year 2020. So they did a production. They had a production of around 20,000 units of K. Then they sold. The sales they made were 15,000 units of that particular product. There were these costs involved, the production costs. One of them was on direct material. The figure there was 2.4 million. We had direct labor, 600,000. We had variable overheads, which is 500,000. And then we have fixed overhead, which is 900,000. They had the following selling and admin expenses. The following selling, so we have a sales commission, and the figure there is 250,000. We have general expenses, and the figure there is 160,000. Then we have overheads, which are fixed in nature, and the amount of money is 240,000. Then we are told that the selling price for this product K is shillings 300 per unit. So we have that selling price of 300 shillings per unit. We are required now to provide our P&L on the basis of absorption accounting. So what we are required, number one, is our profit and loss on the basis of absorption costing, and then number two is a P&L on the basis of marginal costing. So that is what we want to look at to try see how to sort it out at the end of the day. Let me try see if I can get I don't know if this, I hope this will work. So let's try work this out. So we have our absorption costing, P&L, of course, for the year ending 31st December 2020. I think that was what we had there. So we have, I would talk of, let me talk of some units. I would talk of some selling price there in shillings, and then I would have there something on value, of course, in shillings. So we have what is this now? We have our figure for sales. Let's start from there. We have our sales. The unit that we've been given is 15,000. The unit selling price is 300 shillings. If we multiply this times that, let me just check what we shall get. That should be around 4.5 million. Yeah, 4.5 million. Then, of course, now we are less cost of goods sold, cost of sales, and our cost of sales there. Still have this. I don't know why the screen was going off. So our cost of sales, we have direct material. The figure there is 2.4 million. We have direct labor, and our figure is 0.6 million. Then we have variable overheads. The figure for variable overheads is 0.5 million. Sorry, my pen today is not behaving well. Then we have fixed overhead that we were told fixed overhead was how much. Fixed overhead, let me just check it out here. Our fixed overhead was 900,000. So we have our, let me just move to that particular one. Let me get my place right. So we have a fixed overhead. The figure is 0.9 million. So when we add all the cost of goods and the cost of goods, so now we are adding, what we are adding is these figures, the 2.4 million, 0.6 million, 0.5 million. We are also adding 0.9 million. So let me just add it here so that I get it right. So we have 2.4 million plus 0.6 million plus 0.5 million plus 0.9 million. That's a 4.4 million. So we have a 4.4 million there. Then this one we less closing stock. And our closing stock, they had produced 20,000 and sold 15. So that means we have a closing stock of 5,000 units. If you remember from our previous class, how we were now calculating the cost of closing stock. Let me try see if I can get another pen here. So our cost of closing stock, let me do a working here in the next sheet here for our closing stock. So we have closing stock. So we are saying it costs, the total cost of production is 4,400,000 shillings, and this was used to produce around 20,000 units of product K. So if you look at that production cost per unit, then we multiply by the 5,000. 5,000 has come from 20,000 which was produced minus the 15,000 which was sold. That is what gives us the 5,000. So if you multiply, if you divide the 4,400,000 divided by the 20,000 units which were produced, you multiply that by 5,000, then you get the cost of closing stock, which will come at, let me just do it here, that is 4.4 divide by 0.02 times 5,000, that is 1.1 million. So this gives us 1.1 million. So our closing stock is 1.51 million. So let me get back here. So we are subtracting a closing stock of 1.1 M. So once we do that, we have our 4.4 minus 1.1, so we have a 3.3. We have a 3.3 million. We have a 3.3 million. So when we subtract this cost of sales from our sales, we will get our gross profit. Our gross profit. And remember, our sales, we had calculated the figure here is 4.5 million. So this one should have gone down. That's what we are subtracting to what is down here. This is where it is. So the 4.5 minus 3.3. So we have a 4.5 minus 3.3. We get our gross profit of 1.2 million. 1.2 million. So that's what we have there as gross profit. Then we subtract our selling and admin expense. So our selling and admin expense, we have our, let me just now put it over here. Let me get our next sheet there. So we have our gross profit. The figure there is 1.2 million. We have our selling and admin expense. We have our sales commission, and the sales commission is 0.25, that is 250,000. We had general expenses of 160,000, 0.16. Then we had overheads, which were fixed in nature, and the figure there was 0.24. It was 240,000. So if we add all this, that is 0.25. Let me just add it here. 0.25 plus 0.16 plus 0.24, we end up with a 650,000. So that is 0.65. So if we subtract that, so that we get our net profit. So our net profit will be 1.2 minus 0.65. So that will be 0.55 million. So that is our net profit based on absorption costing. We have picked all the costs that have been involved, and we have looked at them, and we have managed to arrive at 550,000 shillings. But the question wanted us to, of course, determine the profit and loss account on absorption costing, and then the P&L account also on marginal costing. On marginal costing, if you remember from our previous class, we had indicated that this is where we pick up the prime costs and we add over to the variable overheads to give us the marginal cost. Then we treat the fixed cost after that particular treatment of the variable costs. So let's try work this out now. If let me try get this other background now for the marginal costing. So we have marginal costing P&L as at, of course, 31st of December. The year I think was 2020 for Cuman Company Limited. So of course we have our units again. We have our selling price, of course, and then we have our value at the end of the day, and our sales. We are told they sold 15,000 units. They were selling them at 300 shillings. That we found to be 4.5 million. And then now we say less cost of sales. And our cost of sales here are now direct material, and direct material there is 2.4 million. I think I've captured it right. Then we have direct labor, and direct labor is 600,000. Then we have variable overhead. So in this particular place we only deal with variables. We don't deal with anything fixed, and our variable overhead is 500,000. So if you flip back from what we did on absorption costing, we had our figures. We had the direct material of 2.4, we had direct labor of 0.6, we have variable overhead of 0.5, and then we also had our figure for fixed overhead. So there's a fixed overhead of 0.9. But when you now come to our marginal costing, we only have these figures. We have direct material, we have direct labor, we have variable overhead. We don't have anything on fixed. So when we add this, it's good to quench my thirst also as we get to solve some of these issues. So we have 2.4, we have a 600,000, that is 3 million. 3 million, and then you add that particular 500,000, so we get our figure here of 3.5, 3,500,000. So 3,500,000, of course it is less cost of sales, so that means cost of sales is all this less our closing stock. And now we work again the workings for our closing stock. Let me have a normal plain paper. So workings for closing stock. So working for closing stock there. So we have so it has taken us, of course we can even do the normal math that we used to do, that producing 20,000 units would now cost us the figure that we have here of 3.5 million. So that produces 3.5 million. So we would do this in our small primary. Then the remaining stock, because they produced 20,000 and they sold 15, so they have a closing stock of 5,000 units. So you would say if 20,000 units it was equivalent, producing it costed 3.5 million, how much does producing 5 million units cost? Of course, we do the cross multiplication, and so we have 5,000 times 3.5 million, then we divide this by 20,000. If you do that, let me see what we get there. If we do that, so we have 5,000, sorry, times 3.5 million, then we divide that by 20,000 units. So this gives us 875,000. So that's our working for closing stock. So we pick up from here where we have our figure here of 3.5 million. That's what we are subtracting. So we have that 3.5 million. Let me do it in I don't know if I can clear this, then I do it in red. Yeah, so that so we have that 3.5 million. That should be from our slide number. Let me reference it to slide number 15. So this is as per slide 15. Then we are subtracting less closing stock, and closing stock we have realized is 875,000. So when you subtract 875,000 there, you get 2,600,000. Let me just clear it again. That is 3.5 million minus 875,000. We get 2,625,000. This one we are subtracting from our sales so that we can get our contribution. remember our contribution was sales minus marginal cost. Sales minus marginal cost. So our sales was 4.5 million. We are subtracting that particular marginal cost, which is what we have calculated as 2.6. So when we subtract from the 4.5 million, we end up with a gross contribution of 1,875,000. So that is 1,875,000. So we now less our selling and administration expenses. Selling and admin expenses. Sorry for my pen today. So the first one is the sales commission. So we have our, let me do it in the next page. So we have selling and admin expenses. So the first one we have there is sales commission, which is 250,000. Then we have general expenses, and the figure there for general expense is 160,000. When we subtract this, and of course these are expenses which are not fixed, and when you add them, that is around 410. If you now subtract them from what we have over here of our, this is contribution gross of 1875 minus 410, then you get that is 1465. So this is what we call net contribution. So that particular net contribution, we will now subtract less all the fixed cost, all of them, and the first one was a production overhead of 900,000. The next one is the element of overheads under the selling. Let me just say the overheads under the selling and admin overheads, which are fixed in nature. Remember, there was that element which was fixed, which was around 240. So when we add these ones, it gives us 1.14 million. So when you subtract that from the 1465, the net contribution, you end up with a profit of 325,000. So if we are doing our net profit based on absorption costing, our net profit was Kenya shillings 550,000, but our net profit based on marginal costing, is at 325. Of course, you'll realize that there's a difference between the two, and if you were to subtract that particular difference, you'll get that is a 0, 0, 0. That's a 5 there. That's a 4 minus 2 is a 2. That's a 5 minus 3 is a 2. So you get a 225 shillings. And this is how we reconcile between marginal costing and absorption costing as we come to the end. Our slide number 20. So when you look at, let me just pick it up, that when you look at the difference between the stocks of marginal costing and absorption costing, the closing stock, you would see these figures. Our closing stock here was 875. Another closing stock on this other end was that was 875. That's where we did the calculation. I want to get this other one. The first one we dealt with was 1.1 million. So when we come to the tail end, so one particular closing stock is 1.1 million. The other one is 875. And when you do the difference between the two, let me just check it out. When you do the difference between the 1.1 million minus 875,000, you also end up with a 225,000. So you have the same figures there. So the difference between absorption costing and marginal costing now is that particular difference in profit is caused because of the way we have valued our stock, because of the way we have valued our stock. That brings us to the end of our class today on marginal costing. When we on absorption costing, sorry. When we meet again, we will look at the issues on our next particular topic as we move away from this topic of marginal costing and absorption costing. Till then, may God bless you. I hope you will get time now to Google other things to share more of this particular discussion, to read wider again from the course outline that we have shared in class, and of course to do more practice from other quarters, so that this becomes a leaping point for you to learn better things on this particular discussion, to be able to make better decisions as managers. Otherwise, thank you so much. Asanteni sana, and God bless you. See you. I don't know whether next week we'll be having our classes again on face-to-face, but I will also liaise with the class rep, so that if we don't have them on a face-to-face, then we can be able to have our class again online. Asanteni sana.